Good afternoon again, and welcome to the next panel, Lessons Learned, Challenges Faced, and Value Creation. Leading investors share their war stories and pearls of wisdom. Our moderator will be Matt Karnes, founder and managing partner of GreenWave Advisors, Michael Gruber, co-founder, managing partner of Salveo Capital, Vikas Desai, partner, Achari Ventures, Sergey Sherman, managing director, Tuatara Capital, Sean Stiefel, founder and CEO of Navy Capital, and Jeffrey Monat, senior partner at Merida Capital.
All right. Welcome, everybody. Thanks for being here.
Thank you.
So I thought we would kick it off by having each of you give a little bit of background about your fund, your strategy, what's going on in the current environment.
Sean Stiefel. I started Navy Capital in 2014, pivoted to really focus on cannabis in 2017. We are SEC registered hedge funds, predominantly focused on the public markets, so we have a lot of private investments, and really focus specifically on kind of the larger MSOs, some of the smaller private single state operators and brands.
Good afternoon. Michael Gruber of Salveo Capital. We are a dedicated private equity cannabis fund. Had first launched that in 2016. We currently hold positions both in private and public companies based on a number of our private companies going public. And I've been actively investing and advising companies in space since 2012.
Hello, everyone. Sergey Sherman, Tuatara Capital. Founded in 2016, raised two different funds, invested about $400 million in the industry. Strategy is basically private investing. We invested in 17 portfolio companies, have 4 exits, really focus on limited distribution markets, brands, tech, and other ancillary companies.
Vikas Desai, founder of Achari Ventures. We started investing in cannabis in 2018. We primarily focus on the earlier stage side, mainly in ancillary related businesses. We've got 28 portfolio companies across 2 funds. We also have a public SPAC vehicle that was initially focused on the sector.
Hi, I'm Jeff Monat. I'm a partner at Merida Capital. Merida is a private equity firm that is solely focused on the legal cannabis and hemp industries. We have AUM of approximately $300 million, over 70 portfolio companies, and we're currently deploying our 4th fund as we speak.
Great. I probably should give a little background on who I am. I'm Matt Karnes. I'm the founder of GreenWave Advisors. I founded the firm in 2014 to provide financial research analysis, due diligence, and all other types of consulting services. And then in January of this year, I became an affiliate partner of Stonehaven, not to be confused with Stoner Haven. And it's a broker-dealer, so we're also able to help companies raise capital. All right, so here we are, another panel, another year gone by. Things are a little bit worse probably than the last time we spoke, maybe not. But if we look at where the public markets were at the end of last year, they were down substantially. So I'm just wondering, just curious, each of your portfolio companies or your fund in general, how are you valuing? How has it impacted valuation? Has it been commensurate with the downturn in the public markets? A little bit better, a little bit worse? Where are we with that?
When we look at our privates, we mark them effectively based on a series of comps. And given, obviously, what's gone on in the public markets, we've marked investments down 100%. We've marked some down 90%. Big high-profile ones like PAX, we've marked down the vast majority of it. I think you have to. It's anything done in like the 2019, 2020, 21 vintage is most likely substantially underwater.
Yeah, it's not happy times. So the market is down, as just was said. Most of the public companies are down, 90+%. There's always a lag that you have for private companies in terms of the valuation going down. But for us as well, we're pretty proactive in looking at, typically we value it at the last, fundraising event, as long as it's also within a close proximity to the current time. Yeah, obviously, the further you go out from the last financing, especially in a difficult environment like this, we've made substantial write-downs as well. And I believe you'll continue to see throughout the end of this year, private companies will start to catch up in terms of the markdowns of them relative to the public comps.
Yeah, same with us. I mean, I think we're obviously a registered investment advisor with the SEC. Everything's audited. I mean, you have to really start with where the public comps are, and then you make adjustments accordingly. But we have been pretty aggressive in marking down our portfolio. But at the same time, I think we also recognize some of these marks are transitory because I think when we look through the underlying intrinsic value of some of our companies, we believe that they're worth more than the marks. But we're obviously marking down the portfolios in accordance with public comps and other types of guidance.
Yeah, I would echo what everyone just said. Everything stems from the public markets, and that drives a lot of the valuations that we see. And I think cannabis is obviously in a tough place right now, and the hope is that managing duration and getting through it will reverse some of the valuation impact that you're seeing right now for companies that actually get across the finish line.
Yeah, a lot of the same. Merida is a SEC registered advisor, so we do have to follow pretty stringent quarterly valuation marks. In addition, we have third-party outside firms that help us value harder to value private securities. And for Merida specifically, it's a little bit different than a lot of the other traditional private equity firms insofar as we have an operating team that also applies for and helps operate certain state-based licenses for cultivation, retail, which is a little bit more idiosyncratic in terms of how those startup businesses are valued and can accrue value to our LPs.
So recently, it's actually becoming more widespread. Financial statement restatements, quarterly, annual, audited. We're seeing more and more of that. So when you're doing your mark, you're marking your portfolios, and you're relying on financial statements. Is that a concern among you guys as to whether or not these are even reliable, some of these financials?
I mean, you have to trust at some level audited financials, but I can tell you more on companies we don't invest in. When we get decks, you cross-reference it with what you see in like BDS or Headset. I mean, there's a lot of BS out there. So for sure, you can't take everyone at their word, but if you're not going to trust an audited financial, you really can't trust anything.
Well, I mean, some of your companies too, though, are privates that maybe not necessarily be audited. So
most of ours are.
Okay.
Yeah, I would say from the private side. Yeah.
Oh,
Feel
we're
free.
up now.
No particular
Wow,
order.
Yeah,
I like that. Okay. Let's do it.
I think from the private side, you've got to trust the businesses, and I think there are reporting requirements, and so private companies at a certain stage will get audited, and so kind of once they're audited, I think that's a lot. You obviously get more comfort there, but when you make the investment decision, you kind of go through this whole process, and there's definitely some trust and diligence that goes into that, understanding the financials, and then hopefully on a go-forward basis, you're getting reporting that's frequent enough to give you comfort. But it's obviously harder at earlier stage for private companies than it is for later stage private companies and public companies that have much stricter audit requirements.
I'd also add, we do a lot of early stage investing as well, and not all of our portfolio companies, do annual audited financials, but because we have a fairly large team of, 25 or almost 30 employees at Merida, we oftentimes have positions on boards of directors and are very much, in a dynamic dialogue with both the CFOs, CEOs of the companies we invest in. So we try and make sure there's a very open dialogue between both sides, where hopefully surprises don't come out that are, typically in this industry they're negative. So we try and mitigate that as much as possible.
Yeah, the one thing I would add is it's a requirement for all of our private companies to be audited. If they're not, then there's usually some kind of a requirement for us to put money in for them to become audited within a certain period of time. B, our approach is very concentrated. It's much more of a traditional private equity approach where we are sitting on every board of every company that we invest in. We add what we like to think, quite a bit of value to these companies. So we have a lot of visibility beyond just the financials in terms of what is going on with these companies. And if they need assistance, we usually, are aware of that, well ahead of time.
Great. So liquidity is a really hot topic these days in cannabis, in the world of cannabis. A lot of companies are not going to make it. Some are stretched, in terms of their leverage. So I'm just wondering, out of your portfolio companies, are you getting, calls every day for more money? Or, how are you able to help with any funding gap?
So I've been investing in private companies for 25 plus years, and you have waves of markets, waves of interest within sectors. But, over time, the number one reason most companies fail is the lack of money. You sort of either run out of time to show your product or service, or the market has a difficult environment. So right now is an incredibly difficult time. And so when talking with our companies, that's one of the first things that we ask companies is, number one, what's your burn, how much cash you have on hand, and how long you could last. And depending on what that answer is, it's about, you need to be proactive about reducing costs as quickly as possible. Clearly, many companies were really slow in reducing burn. And if they're having less than 6, even sometimes 9 months of cash on hand, we're trying to really push them to go out and raise capital, as well as dramatically reducing costs. So it is really difficult. The last 24 months have been really hard. You've seen a lot of companies go out, into receivership. You've seen a lot of mergers. And also, we've luckily been trying to be proactive also in terms of secondary sales, in the idea of when companies were trying to raise money, of also looking for those opportunities to find other buyers. And then the last point is, as investors, you always have to have money sort of on the sidelines and ready for these difficult times. And sometimes there's pay-to-play, provisions where you need to put in money to survive. And there's lots of times there's very juicy terms for that last money in. So although money is really hard to raise right now, if you have money on hand, you're able to really dictate terms. And so there's some really good deals out there for companies that are maybe have good products, but they're short on cash.
I think it's an interesting time because you just don't have the money that was in the system in 2021 and prior. So like a state like New Jersey, which is just economically a much better opportunity than Massachusetts, you're seeing licenses not even have a shot to get built out. So you're going to see a more rational market because of this dynamic, but you also don't see companies between, call it like 30 million of enterprise value and 300 million because there's no one there to fund them. So it's an interesting time in that regard as well.
Yeah, and I agree with that. I would also add, it also matters who's around the cap table and around the table with you in some of these companies. I mean, generally, when we take a look to make new investments, we do take a look at who else is at the cap table and whether or not our partners have additional capital, because we know sometimes these companies will require additional capital if the business plans don't work out. And that is hugely important, especially in an environment like this, where if we go out to raise external capital, it's very expensive, it's very dilutive, it comes with all kinds of bells and whistles. And a lot of times it's easier to say, look, company needs $5 million. You just go to the existing investors, and if they have it, usually, that's what we try to do.
Yeah, I would just add to Sergey's point, most of the liquidity that exists is through the existing investors today. it's very hard to raise capital that's already not on the cap table. And so I think from our perspective, it's very hard to underwrite investments where you don't know where that next round of financing is coming from. And so there either has to be a very clear path to profitability or a business that's already profitable. And that's, from that perspective, the landscape has changed dramatically. Otherwise you have to assume that